Hello, today is let me check, it's the 8th of May 2012. It is a Tuesday, and this video will be technical analysis on the US dollar index. If you want to know more about an index, happens to be, you can do research, but normally it goes through what's in a particular item of something. So an index of a book will list in particular pages what subjects are. Index for a indice, which is like the S&P 500, list all the companies. And an index within this lists other fiat currencies. So like I say, I'm going to do technical analysis on the US dollar index. If you want to know what a dollar is, and I literally mean this, not on a joking standpoint, then that's something else that you may want to research. And when I talk about wanting to research what it tangibly is, how it's created, and what type of positive and negative effects that it may have. If you want to do research on technical and analysis and all that, you know what, I'm just trying to do an intro in here. And let's get started. Okay, so we have a low of 78, we have a high of 82 on this chart over the last 100 days. If we do basic math, we can take 82, subtract 78, we'll get 4. How I do volatility is I take the highest level, subtract the lowest level, and divide it by the lowest level. Well, within this, it's $3. This is the high and the low. It's $3.74 on 78. Which is what, 3.5%, 4%ish or so. So what's happening is this thing is just not moving at all. It ain't. So this is one of the very few times that I will do a linear scaling chart, because when the levels are this tiny, it doesn't make a difference whatsoever. Now, what we have seen is we got this high and we have this low. So in a Fibonacci analysis point of view, what we've seen was what looked like a failed breakout, and really it still is. And then we come back to test this level, and it breaks down. But then it recaptures it. So we have a failed breakout, which follows up with a failed breakdown. But then it retested this level, and now it's back up. So we look at this within the 18 average. We were in a downtrend in here. We break above it. Well, I guess there's another failed move, if you wish. Then we break below. Then we have a nice break above, but it is unable to start in a bull market by finding support within this level, or at least make it to the previous high. Then we break below the lines, then we break above it, then we break below, and now we're back above. This is really what a true sign of a choppy market is. Pattern of lower highs, of course, has been broken. But overall, this is still in a choppy situation. So we're going to move this on to the weekly time frame. But I've talked a lot about this 80 level, which is pretty much roughly in here, stating that if this level is resistance and we break down from there, that probably end up being catastrophic. And what's happened is, pretty much as I was talking about resistance, it broke down, but like I say, it was a failed breakdown below this level. And again, failed breakout. So resistance, 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 resistance. It's been resisting this level for quite some time. So it could break out in the sense that the more often resistance is tested, the more likely it will be taken out. Of course, looking at longer term analysis would be important for that. And we can just tell in here that as long as it stays above the low of 1778, then it's choppy. And now let's move this on to the weekly chart. And this is what we have on the weekly. So we have a low of 17,270, which is right in here. We have a high of 88.71, which is just a few periods before this, but was the last previous high, and that means we'll use that for Fibonacci retracement, which would have really started in here. And when you had the first test of the first Fibonacci level, it pierced above it or hard, and then pulled back. Got above it this next time, finding support close, pierced below, Then we're finding support, lower high, higher low, and that's what we're making a pattern of right now, is that of lower highs, possibly, because this is the first high, and, well, I guess this is a high, yeah, so lower highs and higher lows. 1, 2, 3, 4. So we got these higher lows, and whenever that's going to be the case, you always have the exact same thing, and that is a symmetrical triangle, which is really from the essence definition of trend. Downtrend line always happens when you make lower highs and lower highs. When you make higher lows, you always have an uptrend line. So however you want to draw it, I guess it's up to you, but regardless of the fact, it's showing that choppy sort of action. It's been playing within this 18 average band for many, many weeks now, going back pretty much to the start of this year, so the whole year within this range. It's been pretty sideways. This has got a downtrend now towards it. Also, you got these upper and lower bands. They're designed close to Bollinger Bands, but not Bollinger Bands. It has the same sort of reasoning, or I don't know what word I'm trying to use here, but when the methodology, I guess, when the downtrend of the upper band and the lower band come up together, that means range-bound markets, and when they really get close, it doesn't mean it's going to happen that period, but it just says to watch out for an explosive move within one side or the other. Let's move this on to the monthly chart. And again, we can see lower highs and choppy lows. The high within this chart is that of 92.63, which is up in here, and the low is 70.70. So it would have started in here. Again, it tried to hold this level as support pretty much back to its previous high, but really choppy, just like I was saying on the daily chart, where you go above, below, and trying to get above it right now. And yeah, so very, very neutral kind of action. You can see again that the bands are coming together. So now let's finish this off within the 100 period or 100 day, which will bring us back to the 1970s. And this is what we get. So the 80 level that I talk about somewhere in here, this is why the importance of it is in play, because it had a decent pierce above back in 1981. And then you have 1, 2, 3 hits of that level that immediately found a nice bounce from 80 up to about 120, which has not been that high since. And then we had another hit, but like I've stated with the situation when you come back to levels, that the more often that you test it, the more likely you take it out. But you also don't expect as high of bounces. So you have a bounce up to here, now you have a much smaller bounce. And after the support level, what's happened is it's really neither been support or resistance, but in the middle, because it's going above and below the key level. So pretty much breaking down below here. That could get pretty harsh. Now the upper and lower bands is like the Bollinger Bands. Now how it's calculated is it takes the 18 period average of volatility, and volatility is defined as the highest level of a certain period, subtracting its lowest, and then again dividing it by the lowest. So I take the front weighted average of the last 18 of the volatility, multiply that number by 3, and that's how much of a percentage increase I take it from this upper band, and same thing again with the lower band. So right now, we are seeing that this is the pattern of the bands in itself. Whatever this high happens to be, which pretty much is just something like that. This high, lower, and, well, this low is obviously lower. We have this low, this high, and right now, this lower band, which really has never been tested since really here, is currently set at 58.60. So it can go a long ways before this thing would be known as that is down way too much. And it once obviously hit the upper band back when it hit the 160 top. Because a big situation for 80 that would really show you its relevance for breaking down is, let's say you do break down below the support line and maybe not go quite down to 58, maybe you do, maybe even lower, but maybe anywhere like 65, 63, and then come back up to 80 and go down, and then maybe test this level as resistance here. That would be a really bearish scenario. But as it's going down below, if and when it does break down below this, then that would probably be within the QE situation, and metals obviously going higher, because let's now quickly bring this back again to the weekly chart. And it was, it's, you know what, even monthly's better for this, because the silver market broke out pretty much as this was going on. And it topped roughly around March of 2008, which is pretty much in here. And then it, from that point, it had a little bit more further downside, then a little bit of upside, and sideways consolidation, all the way to August of 2010, which is roughly in around here. Well, the silver price was going higher as this was going higher, and then the silver price was going higher as this was going lower. Then on the time frame of, let me just look at this again. This is, yeah, so basically the top of the silver, or the breakout of the silver market, pretty much occurred near this top. And then this bottom again was pretty much again when the silver market topped. So this thing breaking down should be very bullish for both gold, silver, and pretty much all real commodities. Thank you for tuning in, and have yourself a great day. Bye-bye.